Good afternoon. On behalf of the Global Interdependent Center's Board of Directors, welcome to today's executive briefing. I'm Don Rissmiller, your host and GIC's Chair Emeritus. Today's agenda includes a discussion on the monetary policy outlook through a fireside chat with Tom Barkin, the President and CEO of the Federal Reserve Bank of Richmond. Our hope is that today's attendees will gain context and perspective regarding labor market scarring, inflation versus deflation, and more. Tom Barkin is the President and Chief Executive Officer of the Richmond Fed. He joined the Richmond Fed in January 2018. In this role, he is responsible for the bank's monetary policy, bank supervision and regulation, and payment services, as well as oversight of the Federal Reserve System's information technology organization. President Barkin served as a voting member in 2018 on the Federal Reserve's chief monetary policy body, the Federal Open Market Committee. President Barkin is a member of the Emory University Board of Trustees and the Greater Washington Partnership. He earned his bachelor's, master's, and law degrees from Harvard University. With that, we'll begin our discussion. Welcome, Tom. It's nice to see you again. So I thought we might start off with the recent data. So we're coming off a March U.S. payroll report showing almost 1 million jobs gained month to month. The labor market in the U.S. has some momentum. Would you expect this type of job growth to continue? And how are you thinking about the near-term U.S. economic outlook?
I do think it's going to continue, and I think it's going to continue in part because I remain optimistic on the health situation. Increasingly, I'm in conversations with people who have gotten both shots of the vaccine. The case rate's down. The case rate in the age range of people who get in the vaccine is down. So my hope and my base case is that we're on the backside of this. There's obviously risk there, variants not the least of which, if you've seen any of the recent articles about places like Michigan. But I am hopeful that we're on the backside of this. And if we're on the backside of this, two things are going to happen, which are going to be great for the job market. One is the last elements of business that have remained either shut down or under capacity, think sporting events, movie theaters, restaurants, bars, and the like, should have the opportunity to come back closer to normal. And the second thing is that people whose participation in the workforce has been constrained by participation challenges, most largely childcare, elder care, are going to have opportunities as kids go back to school or summer enterprises. So I think both of those checks on the labor market are likely to be released, and if and when they are, there's still 8.5 million more people out of work than there were 13 months ago. So I think there's a big opportunity still in the labor market.
Do you have estimates of how much scarring we've seen in the labor market? We've certainly seen a rise in permanent job losers within the household survey. Are some of these jobs never coming back? And is that a concerning phenomena, or is the labor market flexible enough where we'll adapt quickly?
Well, when we talk about scarring, I always start with 10 years ago. And 10 years ago, we were really worried about scarring in manufacturing and in construction. Obviously, those two sectors have been booming in this cycle. So I think we will see scarring, but it'll be in different places. How many people who have chosen to stay home with their kids might choose not to come back in the workforce? That's one version. I'll call it participation scarring. How about the people who are the last people into the workforce working in these lower income personal contact service jobs? Will there be jobs for them? But maybe the worst element of scarring is kids in the future workforce, and in particular those who have not been in school or have been remote and not learning as well. We're doing a big series on our website, we call it District Dialogues, on this whole issue of the implications of remote learning and the cost and scarring that it's driven on the future workforce. And that's actually the place I'm the most worried.
Got it. No, and certainly the education issue has been an important phenomenon over the past year. In terms of the oddities of this cycle, because this really is a different business cycle than what we've seen in recent memory. Usually business cycles are driven by goods and durable goods and inventories, and sometimes we have a financial event caused by that type of correction. This seems different because, as you said, the manufacturing sector is recovering quite nicely, and the global manufacturing picture has recovered. It's really in services where we've had still some some significant issues. And so, as an example, within the labor market report, average hourly earnings were actually up on a year-on-year basis, but that looks like a mix shift. It looks like we had layoffs concentrated among lower pay jobs over the past year. Do you expect that to reverse? How quickly will that reverse? And is there anything else about this cycle that you would point out as being particularly odd when we try to put it in historical context?
Well, I thought I knew how I was going to answer till your last part. There's a lot of odd stuff about it. So I'll try the labor thing and then I'll just talk about oddness. So the New York Fed did a study a month or so ago. It suggested that the highest income part of jobs actually were up year over year, and the lowest income part of jobs were still down 14% year over year. And obviously, if that's the case, you're going to have a compositional effect in your average hourly earnings. The jobs I see coming back as we reopen the economy are going to be disproportionately these personal contact, lower income jobs. And so I do think you're going to see some of that compositional effect reverse. I am pushing hard as I talk to my contacts on the question of how much pressure do you see in the labor market? And I would say there's a lot more pressure on employers today than you would think, given the level of unemployment and the number of the fewer number of employed people that I mentioned earlier. If you're in healthcare or you're in technology or you're in construction or you're in manufacturing, you really are struggling to get workers. And so especially at entry level, there is some comp pressure there. Even in the service industries, you would think it would be really easy to get people back. But yeah, I've talked to 2 or 3 people even this morning telling stories of their challenges, rehiring cooks and bartenders. And I think it is a little bit continuing health risk. It is a little bit a population that might have enough money that they can tide themselves over for a little while longer. I think it is a lot family care, as I was talking about earlier. But I think there is still some comp pressure on the bottom. So I expect the compositional effects to reverse, but I think we're going to start to see, as the economy tightens, a little bit of comp pressure as well. In terms of what's been odd, I mean, just this combination of shutting down the economy and then putting $5.5 trillion of fiscal stimulus into it has created a number of odd effects, some of which I've referenced. You've got, probably $2 trillion plus in excess savings in people's pockets. Normally, disposable income would go the other way. The banks have been very healthy. Normally you'd see, a lot more defaults. The shift from services to goods, meaning that the manufacturing sector, has been strong. Again, strange. Credit card balances have gone down as opposed to going up. Again, another thing that you just don't normally see. So I think there's a lot of stuff that's abnormal. But, on the positive side, this is an extremely strong, sharp decline. It has the potential to have an extremely quick recovery. And that's certainly what I'm hoping for.
Does all the good spending worry you at all? In other words, have we pulled forward good spending, retail sales, depending on how much fiscal stimulus we get in any given month, that tend to move in line with checks that are sent out, but those we know to be singular events. Does the amount of good spending suggest to you that we could see a plateau or even a decline, and will that be made up on the services side, net?
Well, I've been trying to study it. There's having savings rates at the level we have is really also pretty unprecedented. You have to go back to World War II to get those kind of numbers. And so how's it going to come back in the economy? And I'm a person that says it's going to come in on both sides. For sure, people who've been vaccinated who haven't been out to dinner for a year are going to want to go out to dinner or go on a nice vacation. I know I will. But I'll also say one of the nature of services is they're relatively constrained. I want to take a nice vacation, but I've only got so many vacation days, so I can't take 4. And I'm ready to get my hair cut, but I can't get it cut twice in a week. So I just think there's some real constraints as to that upside. So I'm anticipating strong services spending, but I'm also anticipating that consumers are going to have still a lot of excess savings in their bank account. And I think some of that will go to goods. And the shift to goods that we saw last year was completely understandable, right? People were shut down and locked in their house. Well, guess what? A new desk chair or outdoor furniture or carpet or paint or indoor furniture, that all makes sense, or lawn and garden. Those are all things you spend on if you're locked in your house. Outdoor recreation was seen as safe. So guess what? Golf clubs or bicycles or ATVs, they all, float off the shelves. And so I think it's eminently rational, and I would assume the same kind of thing is going to happen again this year. Now, I don't think the guys who bought golf clubs last year are going to buy golf clubs again this year, but I think someone who bought a car last year might buy the golf clubs this year. So I'm expecting a strong consumer season from both sides. And I think this excess savings will be a very helpful backstop for the economy for several years to come, not just in 2021.
No, sure. And maybe we could stick on that for a minute and just think about the individuals who bought a new house in addition to the new car and the new golf clubs, because housing has been a very robust part of the economy. Now, there's certainly a split between homeowners and renters, and there are problems in certain pockets. But if we look at housing starts or housing permits or new home sales or existing home sales, abstracting from the February noise with weather-related disruptions, we've had a pretty strong run. So does that factor into the outlook, and do you think that could continue on the housing side?
Yeah, when I was growing up, every person I grew up with knew that a house was what you wanted to buy the second you got enough money, because you would create wealth there. And our parents, of course, had all created wealth in the 60s and 70s through home ownership. I think a whole generation coming out of 2008, 2009 had a different point of view. And so you saw millennials delaying the purchase of houses. You saw a lot of flood into the bigger cities. You saw developers maybe being more cautious about building houses, and maybe financiers being more cautious about financing houses. And so it started before COVID, but during COVID, you got millennials who are getting older and having kids, thinking they're going to get houses. You've got city dwellers saying, I want a place with a little more space. I always laugh and say there's no way to understand the flaws of your house than staying in it 24/7. And so people, either in the short term or maybe longer term from a work remote situation, said, I want to, buy into a place. And of course, rates were low. And all of that demand hit a supply base that just wasn't enough for that demand. You could also imagine that some retirees who normally would be selling out of their house to move into a multifamily situation or a nursing home or wherever might have delayed that decision. So that may have cut supply of housing as well. So you had a ton of demand with constrained supply. And of course, that's what happened to housing prices. I do, hear stories of people developing houses. So I think the supply constraint thing will move over time, but it's slow. And the elements that I talked about that support demand feel to me like the kind of elements that will continue to support demand.
No, thank you. So you mentioned fiscal policy previously, and fiscal policy has obviously been very aggressive. We're using the word trillion more than I think I ever have anyway. So how does that factor into your thinking on the forecast? Not necessarily do you have a preference one way or the other, but was that one of the big factors in the upgrade to the economic outlook? Is that still something you think will be significant over the next year as you try to construct a forecast for the U.S. economy?
Well, there's no question in my mind that the fiscal support that's been given to the economy over the last year has been meaningful in helping us bridge to the other side. You can look at bankruptcy numbers for small businesses as one indicator. You could talk about the stuff I was mentioning earlier, whether it be credit card balances or savings rates or the like. I don't know about my colleagues. My own forecast, the thing that was most meaningful to me between December and March was the rollout of the vaccine and the drop in cases. I mean, in December, we were in the middle of a surge, and the first vaccines were rolled out actually after our last FOMC meeting. And so you heard numbers plus or minus a year in terms of the pace of rollout. There was lots of controversy about the effectiveness. And then you get to the middle of January, and steadily, and I think with a very steep slope, you see cases come down, hospitalizations come down, deaths come down. After an initial month of how is this thing really going to roll out, you start seeing 2, 3, $4 million doses a day, on the vaccine. I'm over 55, so when you first get the email that says you're over 55 and you qualify, it just changes your whole outlook. And I think that was the biggest change. Now, there's no doubt in my mind that this latest fiscal stimulus and the one in early January, which was after the December meeting as well, has a positive influence on consumer spending. And you can see it, the real-time card metrics show it immediately. When that stimulus comes out, probably a third of it goes straight into the economy. And people who serve low to moderate income customers, I've talked to shoe stores or beauty salons or whatever version of that, they could see it totally in their numbers too. So I definitely think that helped. But you just have to, we got into this crisis from a health standpoint, and we're going to get out of it from a health standpoint. And the fiscal stuff is useful support, but the biggest upgrade has been the health side.
No, that makes sense. It was a health-related issue on the way in, and it will be a health-related issue on the way out. And it's somewhat fortunate we have the vaccines as quickly as we do, given the history of how long some of these have taken to develop. So maybe I'll just stick on that and think about just the risks to the outlook. It seems like there's a widespread expectation we're going to have quite strong GDP growth and employment growth over the next several quarters. Are there risks? Are they balanced? Are they skewed? Could we actually do better than these current numbers, which are quite strong? Or are there other things we should be thinking about in that space?
Yeah, I don't know. I guess if you think balanced or skewed, it's off of what forecast. So I have to think about that for a second. But the way I'd put it is this. There's one non-trivial serious downside risk that is, I think, low probability, but quite meaningful, which is, call it Brazil risk, that the Brazilian variant or another variant comes in and takes us back to December. And all of this optimism that is fueling the economy, comes to a slowdown or a halt. That is a very significant risk that I think is low probability, but high severity. If you take that out of the economy, then I think the biggest risk I see is supply chain. The demand is very strong. It is outpacing a lot of manufacturers who got behind in the shutdown and have really never caught up. You've got constraints in the ports. You've read about, Long Beach and the like. If we all want to go take vacation at the exact same time at the exact same resort, it's going to be hard to get a room. I tried to get a rental car in Tampa 2 weeks ago, and it was $380 for a day. That wasn't because they raised their prices; it was because they had no cars, right? And so that's the kind of thing that could happen. And of course, if you have those supply constraints, that puts the topic of inflation on the table. It also puts the topic of, are there constraints on the GDP upside, right? Manufacturers can't produce to meet the demand. That's less upside than you might think they have, given willingness to spend. And so, that's a second, risk. On the upside, I guess, I've never quite liked the phrase upside risks. I know the economists like it, but upside case. The upside case is most of the scenarios you see don't spend a third of the excess savings that people have in their pocket. So if there's more deployed into the economy than people are projecting, then I think there's a much more significant consumer upside.
And so maybe we could tie that into the inflation outlook. I mean, the central tendency projections from the FOMC seem to have a pretty soft landing. I mean, there's robust growth and then some move up in inflation, but all in all, I mean, if those forecasts are achieved, this looks pretty good in terms of the policy outcome. So is there risk on the inflation side? It seems like it'll move up in the near term just on base effects, as Fed Chair Powell has talked about. I think most people are willing to look through that, but they're less willing to look through the bottlenecks and the supply chain concerns, because I think that strikes people as more real, or at least more fundamental, that those prices might be sticky after you see some increases for those reasons. Are you confident that any move in inflation will be transitory?
We'll see. Here's my take on inflation. You're already seeing price increases in multiple places: construction materials, agriculture, commodities in general. And that's, I think, driven in large part by, demand for those things, particularly on the construction side. If you note the producer price index, the last 12 months is 2.8, but the last 2 months, I won't get these numbers right, I think it was 1.3 in January and then another 0.5 in February. So a huge part of that 2.8 has come in the last couple months. And as you talk to folks, input costs, X compensation, input costs are going up. Of course, the billion-dollar question, or if we like to say trillion now, the trillion-dollar question is how much of that's going to get translated into consumer prices. sorry, one more thing. We've already talked about housing prices, so there's also asset prices that are increasing. So consumer prices, you know this, 1.4 is the core PCE for the last 12 months. We will have base effects for the next 3 months, so we will round out the deflationary months from last year, and we will have some, and so even a normal set of months will have that 1.4 increase over the next 3 months. I would also remind everybody that the next 3 months actually had very high increases in prices, and so the base effects will work the other way for whatever that is, June, July, and August. I think you're also going to see a return to normal in certain sectors, right? So these service sectors, forget just the base effects. If hotel prices don't come back somewhere near normal, at least on the leisure side, I'll be pretty surprised. And same with airline prices. I still think that's going to be a slower to develop story because so much of those businesses' revenue model is built on business travel, which is probably a fourth quarter and beyond situation. But many of the services that have had deflationary effects, I also assume will do it. So those two things are clearly going to happen. And I think what that means is you'll have real price pressure this year. The question really is, what's price pressure next year and the year after? And so you look at expectations, and if you look at market-based measures of expectations, they firmed around our target, but they're certainly not past our target at this point. And it's particularly reassuring if you look at the 10-year number, which is still at or a little bit below our target, despite the price pressure in the next 5 that it forecasts. So it sort of says no one's lost control from a market standpoint. But I also try to test it with the executives that I'm speaking to. And in the last couple of days even, I've spoken to power tool manufacturers and tried to ask, are you going to pass on these cost increases to Home Depot and Walmart? And they're not, because you've got big, powerful national chains with bargaining power, and they're just very concerned about their ability to keep business. And I've talked to a furniture manufacturer who said, actually, 80% of my customers shop me online before they come to this shop. And, if I'm out of market online, then I'm nothing. And so, of course, there'll be some people with these stock out situations to decide to take it on price, but I'm talking to a lot more people who are more likely to just bear it and try to get to the other side and not take a risk with the lifetime value of a customer, not take the risk being perceived as price gouging, and who still don't see the long term as being, a 4% world. They still see it as a 2% world.
So if I'm hearing you correctly, please.
But we'll see. But we'll see.
Yep. Right. It sounds to me like it's really the small business that is unable to see the pricing power that would be necessary to make this a big change in inflation expectations, that there's still such an anchor, whether it's the global environment or the technology environment or the competitive environment. These big structural forces that have held down inflation and inflation expectations really haven't changed all that much. There's an issue with reopening services, and maybe you pay up for your next vacation, but you don't pay up 2 vacations later and 3 vacations later, certainly not in the same percentage year after year. So is it fair to think this is a small business issue? Is that what you're hearing from contacts, that there's just not the pricing power throughout the supply chain?
Well, no, I would agree there are small business issues, but I think it's also a big business issue. I mean, there is a whole sector of the retail economy that is selling based on everyday low price, that fights as hard as they possibly can to avoid anything that would take price up. That could be Dollar Tree or Five Below, that could be Walmart or Home Depot. But the massive parts of the retail chain that are, if you will, helping the consumer keep prices low. And whether they're small or big vendors into those big box retailers, they're really struggling to capture price, unless you're in a commodity that's effectively a pass-through. Lumber would be a pass-through, or stuff that has a heavy oil component would be a pass-through. So that's one piece of the puzzle. I think there's another piece of the puzzle, which is, I love to buy books, but when I go to a Barnes & Noble and I see a book that's at $30, I go on my phone. And if the book's $14.99 on my phone, I press buy. And so there's, some of the barriers to price shopping have dropped considerably. And then you still got access to global labor pools and global product pools. Both, yourself as a manufacturer and also, your customer as in terms of access to alternatives. And all those mean that you've just got disinflationary forces that are, tough to break.
No, that makes sense. So thank you, President Barkin. We'd like to take this time to bring in our audience Q&A. So audience members may have entered questions during the registration, but I'd like to remind everyone you can enter your questions for our speakers under the questions tab on the dashboard. So we have a few questions that have come in. Let me try to combine several of them. First, we've talked about excess personal saving. Does that tie into low interest rates? In other words, there's been this discussion of a global glut of saving in the past. Is there a relationship today? And if the saving picture changes, if we redeploy that saving, could that actually cause interest rates to increase? And would that be an acceptable outcome if that's the reason?
Yeah, okay, so there's a lot there. So obviously this notion of a savings glut does matter. And in particularly when you're looking at the U.S. 10-year long bond yields, I believe that is an instrument that's, very much in the sweet spot of people globally. And, this glut of excess savings, as Bernanke famously said, I do think comes into those bonds. And when the rates get disproportionate versus the rest of the world, creates a bit of a ceiling on it. We've certainly increased our savings this year. Many other countries have as well through whatever stimulus they've done. And I do think that, people are looking for a place to invest. By looking for a place to invest, that's clearly, supporting asset markets, and it's probably holding down bond yields. So the answer is yes. In terms of whether all this has changed, several of you have probably read Goodhart's latest book. I thought it was interesting if you haven't. And he makes the point that a lot of the forces that we're talking about, whether they be demographics and its impact on savings, globalization, its impact on cost structures and the like, might reverse. And if they do reverse, that could, in fact, he makes the case, take the neutral rate up. It's a really interesting book. It also talks about megagalactic forces over, let's call it 50-year time periods. So it's hard to know where the tipping point for all that is. But it is, I think we should never assume the environment we're in is going to be the environment tomorrow. I mean, that's why I'm talking to as many businesses I'm talking about to try to understand whether there's some moment of change here that we should understand.
Thank you. We have another question regarding supply chains and their link globally, just in particular with the link to China. Do you see more companies looking to relocate their suppliers or at least diversify supply chains?
I do. And I think, first the tariffs and then the virus has kind of made most corporations around the world stop and ask the question of whether they had thought enough about resiliency in their supply chains. It now seems kind of crazy to imagine you could have actually outsourced everything to one vendor or put it all in one country. And so, people definitely are. And, we were in a situation where cars were being manufactured in the US and shipped to China, and supply chains went Europe, US, 3 or 4 times in some different industries. It's just interesting that that's how we evolved. So you are seeing a move toward diversification, a move toward localization. I'd caution people that, especially in manufacturing, it's not that easy to move a plant, stand it up, and have it be fully productive. And there's a real issue of timing to try to get that done. It's a lot of money, it's a lot of time. And if you were in China and you put it in Vietnam, you hope that's the right country choice and that there's not some, collinearity, if you will, between those two. The other thing to caution people on is if you build a new plant in Vietnam, what happens to the old plant in China? And if the answer is you're still operating that, then haven't you increased capacity? And if the answer is you're not operating that, then it probably hasn't closed down. Probably the Chinese are operating it. So, I think there's going to be capacity issues in there. And I guess the third caution is this diversification isn't necessarily leading to that much more onshore because people are still competitive. And so if your competitors have a cost structure that is lower because they're overseas, you might diversify, but you're not going to intentionally take on a higher cost structure if you can avoid it. But I'm definitely seeing that it's just going to take some time to land. And I think there's, even when you're designing that new resilient structure, uncertainty as people are designing it.
So if you're not onshoring, you would be moving out of a singular location. So if it's not just China, it would be China plus Vietnam plus Mexico, something of that sort. Is that the?
You hear a lot of China, Vietnam. You hear a lot of China, Mexico. Um, no, exactly. You also hear a lot of localization. The consumer products companies, for reasons that I think had to do with, consumer perception, had localized a lot of their manufacture to start. So, toilet paper manufacturers manufacture in almost every country they sell in. And so you're getting more industrial manufacturers asking the question of whether they shouldn't be doing more localization. Manufacture in China for the Chinese consumer and the US for the US consumer, et cetera, et cetera.
Got it. We have another question on long-term potential GDP growth estimates. So from a longer-term perspective, what do you think is potential GDP growth in the US? If it's below 2%, could we take some steps to improve our potential growth trajectory?
Yeah, it's somewhere in the range right now of plus or minus 2, but I eagerly embrace your point, because I don't think that calculation, which in my little world is what's your expectation on productivity versus what's your expectation of workforce growth, and put them together. I don't think that calculation is destiny. And so, destiny comes down to the question of, can you move those two numbers? And I think that's entirely possible. I've written a lot on workforce participation, and you don't have to look further than Japan to see that countries that want to work on workforce participation are able to do that. And so we have a lot of upside in workforce participation. It requires a lot of things that we may not be as good at as we should be, like education. But I'd like to think that's higher. I mean, immigration is also a relevant topic for people with the skills that, would fit our needs. That's another, version of it. I'm probably not as bullish on fertility, but I'll just go with immigration and workforce participation. And then on the productivity side, I think we'll see some productivity come out of this particular downturn. Obviously, online shopping or telemedicine being classic examples. But, we may need to, in a world of a constrained workforce, invest even further in productivity. And so I believe both of those can be unlocked. And so I think there is more upside than 2% would suggest. So 2% is more a backward-looking number than a forward.
Right. So, I mean, it's somewhat odd to talk about silver linings to this type of shock because it was a health shock and certainly tragic. But I guess we could think about economic silver linings if we change the way we approach doing business. And it does seem like some of the things we're doing, just remote video, could apply to many high value added services, healthcare, finance, technology. And I guess I see no reason they would go away. So, I mean, another item might be if more people seek essential work, whatever essential in quotes has come to mean over the last year. Is that something where people re-enter the workforce, but re-enter up the value added chain because they became somewhat trained in a healthcare field or something like that? Is there a place to think about that boosting productivity, or are there other ways that things that we've learned to live with, maybe even in terms of deregulation, that certain things have been cut out because they had to be over the past year? If they stay out, could that help boost growth as well? But are there things you're hearing from companies in terms of the change in the way we're going to go back to work that would make you optimistic on productivity?
Yeah, there's some good thoughts you gave. Maybe I just pointed a few, small snippets that are interesting to think about. The role of the expert. So, most institutions, I've worked at a consulting firm for a long term, we had people who were experts. Joe would be a pricing expert. And, you would try to get Joe to come to your client to have a meeting. And the problem was getting a hold of Joe because, Joe always had another client meeting the same day. And actually the other problem was keeping Joe, because Joe was traveling all the time and didn't like his lifestyle. So now if you're Joe, the pricing expert, you can be everywhere. And to the extent he had real expertise that everyone wanted, now you've just disseminated expertise at a totally different pace. And you've kept expertise in ways that maybe you wouldn't have. So that's a classic example of knowledge dissemination, a lever to productivity that I think is massively enabled by what we're talking about. I think anytime you go through a downturn, you reassess your spend. It just gives you a moment to step back. And in particular, if you've had 10 years of an upturn, you have spent on some stuff that now you look back and wonder why you did it. So I think institutions, around the world have already stopped and said, why did I do that? Why didn't I do that? Real estate would be a good example, a concrete example, but there are lots of things like that. New ways of doing business, telemedicine, I mentioned earlier, is a good example. But I would say there's still regulatory barriers. There were issues even getting insurance to pay for it. Now insurance sort of set on a temporary waiver, they'll pay for it. But hey, if you're in Georgia, that's great, but we can't do telemedicine in South Carolina. Well, we ought to stop for a second and ask the question of whether we can't enable some of these things in a maybe you call it deregulation, but in a simplification mode that shouldn't be controversial, I don't think. So I think there's a lot of that stuff. I mean, restaurants and how they use space, these ghost kitchens that are, creating food for, for all these various restaurants in one kitchen for delivery at home. All that stuff I think is really good innovation. On the other hand, we're going to have stranded costs coming out of this. They're going to be restaurants that are too big, or stadiums that are too big, or nursing homes that are too big, or cruise ships that are too big. And there's certainly at least one boat in the Suez Canal that was too big. So, we're going to have to sort that out. But I see lots of opportunity coming out of this.
We have a question that's related here in terms of worker retraining. So, do you think it's realistic that we can retrain workers to close the skill gaps in the economy? This has been discussed for quite some time. Given the number of workers, the 8.5 million number mentioned earlier, if the fiscal stimulus plans don't directly retrain workers for significantly higher paying jobs, will workers retrain on their own, or is this something where more has to be done? Or are we going to look at this the way we have in prior cycles?
Well, it's a great question. I think it's absolutely essential to get this retraining done. It's quite dispiriting to see the drop in community college enrollment over the last year. It's down double digits, and it's easy to imagine that there are people who should be investing in retraining who aren't there doing the retraining. I take heart from, McKinsey just did a study on jobs of the future where they showed all the jobs that may not exist so much at scale, but looked at all the jobs that might exist. And many of them, I'm thinking home health, are places where, personal contact service workers might find to be a natural fit, both in terms of skills and hours. But, you don't just go into home health willy-nilly. You've actually got to train to do it. And so, I don't know if we're going to pass an infrastructure bill or not. If we do pass one, my sort of marker for infrastructure is an investment in the growth potential of the country. And I do think one of the things that would help enhance the growth potential of this country is helping address these mismatch issues and helping people get into places where they can be deployed successfully. And if they work more, they'll spend more. If they work more, they'll pass on that ethic to there's lots of good things about that. So, the 2009 infrastructure bill was intended to be a jobs program. It's not obvious to me we're short we're short manufacturing construction jobs right now. We're actually short manufacturing construction trained people. So I hope that we can do is pair whatever building we do with building of talent behind it.
Yeah, that makes sense for sure. We have a couple questions on debt and deficits. Is the growing federal deficit a concern to you? Do you think there is a debt level that could become negative? Or do we wait for some market signal to tell us the answer to this?
It has not been a concern for me that we chose to invest at a time of crisis to help bridge people to the other side. I think that is what the government's balance sheet is, at least in part for. It would concern me if coming out of this crisis, we didn't take steps to manage our fiscal load, over the coming upcycle that is to come. And, my understanding of how these things are supposed to work is you invest now to get to the other side, and then, gradually and in a mature fashion, you reduce the debt so that you have the capacity to handle the next crisis. And I just think it's interesting to look at Europe and their fiscal response versus the US and our fiscal response. Ours is much more substantial, and our economic rebound has been much more substantial, and at least I believe those are connected. And so the subtle thing is, if you end up with more debt than you want, you just reduce your flexibility to respond to emergencies the next time one comes along. So that's it. It's entirely possible that the markets, will take care of it. I mean, that, there was an era where you had bond vigilantes, and that's what they did when they didn't like the deficit. Whether that would happen here or not, I don't know. And what timing. Obviously, you've got other countries of scale and importance with also sizable deficits that seem to be surviving them. But it just seems to me to be prudent to prepare for the next downturn. And that's the core. Is the reason you want a healthy balance sheet is to be, resilient when bad things come.
Maybe we could move over to the currency side then, and just, do you see, given this profile that we talked about, any credible threat to the U.S. dollar's reserve status over the near term, meaning let's say the next 5 years or so, or given that this was a global pandemic and everybody has seen the effects, is that less the concern?
Well, I think the U.S. is obviously privileged to have the dollar that's in reserve status. I think it's in reserve status because we are trustworthy and we are a rule of law country, and we have highly liquid and we're a stable dollar, and all of the various things that make it a currency people want to transact in. And you could compare it with other currencies that either don't have the liquidity or don't have the stability or don't have the rule of law sort of political confidence. And so I'm not sure I see, frankly, it seemed to be more risk in the mid 2005 era with the euro than it would be today. I'm not sure I see what the threat would be. But I guess if the reason we are the reserve currency is because of how we've led ourselves and what we do, then the biggest risk to it is us. If we were to do something that would somehow inhibit people's trust in the rule of law with regard to currency, those kinds of things. So I think we're the debt ceiling, would be that kind of thing. So I think we're probably the biggest risk. I don't think the environment around us is the risk.
We have a focus question here, whether you have any current thinking on the supplementary leverage ratio, how that is used to resolve the issues with high reserves and treasury debt, and is there any update on that approach? It's been in the news recently as an example.
Yeah, I don't think I'll front run the governors on that. We gave an exemption back in the middle of the crisis, to help banks with the liquidity problems that were there. I think we are on the backside of this crisis, and so normalization of policy seems like the right thing to do, and that seemed like a fine place to start. I think there are fair questions that have been raised about whether the leverage ratio is geared appropriately to accomplish its mission. I think the governors felt that was probably best done in the cold heart of light of day we should study that as opposed to just do something quickly. And so we'll spend some time on it, and I trust in relatively short order we'll come up with a point of view.
There were a number of other tools in the corporate market, the muni market, and some older tools that were reemployed for primary dealers, for commercial paper. They seem to work. In other words, by having those facilities, even if they weren't used, just the existence of them seemed to calm markets down. And so I think it's one of the reasons we didn't have the financial crisis this time, because we had the financial crisis last time and we learned from it. So I guess I would expect that these tools will stay around, but I might ask if you share that view that we've kind of expanded the toolbox. Maybe we'll put the tools away, but we've learned quite a bit and could come back to the toolbox if necessary. But maybe I just ask for your comments on that.
No, and I think you're paraphrasing Jay, who has a phrase I quite like, which is, we have these tools. These tools are in the tool shed. When they're needed, we take them out. When they're not needed, we put them back. And I think if you put them back, you earn credibility to use them again. We all know coming out of 2008 and 2009, there was some noise that ended up being part of Dodd-Frank about, are these appropriate tools to use, and were they used in the right way, and those sorts of things. And I actually think the changes in Dodd-Frank were quite useful, because now the tools were validated and we were able to say, yep, this is a tool we can use on our own. This is a tool we can use with consent of the Treasury Department. This is a tool that has to be authorized by Congress. And, if we go through those hoops, we can use them, I'll call it legitimately. And then, we've put them back. So I think the toolkit's just better developed now, and maybe that makes it more trusted, better understood, which I think makes it useful when you have these times of crisis.
No, absolutely. We have a couple questions coming in on the response, so QE as an example, and then the implications for income inequality as well as wealth inequality. So I guess the central tendency of some of these questions seems to be that the Fed has acted, it may have acted appropriately, but the end result of it was that inflated asset prices, assets are owned by the wealthy, and so you inadvertently perhaps affected the inequality picture. Do you have any comments around that issue? Is that a focus? Is that tangential consideration, or how would you approach that concern?
Yeah. And for those who haven't read it, there's an interesting piece in the New York Fed wrote again in the last couple months that talks about this topic. But I may just be oversimplistic on this, Don, but our mandate's unemployment, inflation. So when you're at 14% unemployment, as we were last April, when inflation, is at 1%, it feels like the time to, put your foot on the gas. And it's not clear to me, and that of course, has the very positive effect of helping the economy recover and therefore helping people at the bottom of the pyramid. And remember, this crisis disproportionately hit people at the bottom end of the barbell, get back to work. It may have a second order effect of affecting asset prices, but that asset price impact is by definition temporary. Because if you increase rates when you normalize, if you get back to normal faster and you increase rates and you normalize, then the rate effect on asset prices ought to go away. So you have a immediate and tangible and long-lasting impact on the futures of these people out of the labor force, and a temporary impact on asset prices that reverses faster if you can get these people back in the labor force. I guess I'm a little confused on the trade. It feels like a pretty good move from an equality standpoint is to get people working. But I mean, I think if we try to overfocus, or if I try to overfocus on, asset price implications of things, I just don't know. Then what do? Do I raise rates to try to reduce asset price? I'm not sure do I raise rates to reduce asset prices and therefore keep people from getting in the workplace? That doesn't seem like the right response. So that's where I kind of get lost in that argument.
One question that might be a follow-on here. What if a significant portion of the population chooses not to return to the labor force, at least in the very near term? If they don't want to work or feel they've made different choices, would you expect the wage profile to change to reattract workers, or is this a concern in some other area?
So I do worry about this issue. Will people come back into the workforce, making the match work between the personal contact service workers and the jobs that are available? And of course, if you have a tight labor market, you'll have implications. We saw this most recently in 2019, right? We had very low unemployment, relatively high participation, very tight labor markets. And we did see some comp pressure, but nothing out of the norm. It was in the 3% range, not the 4% range. And as I talked to businesses then, you'd get a very strong feel that businesses feel price constrained. So they do not feel like they have pricing power. That's the first thing. And so that's not true in every business. It's not true if you're in construction, but in the great majority of the places we study, people really don't feel like they have pricing power. And because of that, they don't really feel like they have the ability to take on, significant increases in their wage burden. And so you see, tight labor markets then resulting in things like much expanded search activities, working much harder in much different pools. You see offshoring to different countries and taking work offshore. You see automation in many cases. You see individual wage increases, but not across the board wage increases. You see operating cost increases substituting for wage increases, like the ping pong table, at a Google building. But people are just really resistant to sort of fundamentally, broadly upping their overall cost structure, in large part because they just don't feel like they can pass it on in price, and they don't feel like they're, going to be comfortable with lower margins.
No, that makes sense. We have a question on the urban centers, so I guess it would be directed to you in the context of have you seen this in cities in your district, or have you talked to business contacts For instance, there is some data on increased homelessness, increased problems in metro areas. Is that something unique to this cycle that we may have damaged the denser areas, benefiting, say, home builders in other areas? But do we have to think specifically about the metro areas, the urban areas, given the nature of this pandemic?
Well, particularly downtowns, you know, I'm not yet comfortable getting in a large, you know, in a 70-story elevator. Maybe some people are. Hopefully we will be, but a lot of them have been constructed in ways that may not be friendly to some of the health scenarios that are coming. And certainly if you're a small business person, you have a dry cleaner in a big office building, it's been a really rough year. So I think a lot of these urban centers are struggling as long as the urban populations aren't there. You know, cities have been around for thousands of years, and those thousands of years include wars and plagues. So I have to believe there's a, you know, there's a there at the other side of this, but it may be different. You know, Main Street in Richmond now has a lot of condos on it. So maybe will they become more residential than office? I don't know. Maybe offices will bring people back, and it won't be, you know, that big of a deal. On the homeless side, you know, crime's another thing I hear about. There probably is something going on there in terms of the police force and the, you know, their staffing, whatever version of it. That's not really something that I'm in the middle of. I'm more stay on the economy part. I do think inner city economies right now are struggling, in part because inner city sort of every day millions of people come in and then millions of people go out, and the millions of people coming in aren't coming in anymore.
Right. And I guess we could say we hope the solution is the vaccine, the same way it has been the solution to other forms of economic activity, whether in leisure and hospitality or travel or retail.
Absolutely.
We have a question here. Are you concerned about hiccups in the financial markets? And this really gets to bubbles, you know, whether it's Asian hedge funds or whether it's certain stocks that have had wild runs. Does the bubble concern register with you? Is that something that we need to be vigilant about, or is this just the nature of what we're going through at the moment?
So a question I get quite often is, are we in 98, 99, or 2000? And that is by people who are worried that asset values are inflated. And I don't have any insight into that, and nor should you trust my insight because I'm not much of an investor. But I do think there's a lot of concern about it. I'm less focused on valuations, and I'm more, I'll call it, interested in leverage, either actual or implicit. I certainly noted in February of 2018 when the first tariffs were announced and some volatility fund ended up, you know, losing 85% of its value in a minute. And I'm pretty sure the people who invested in that fund didn't have that as part of their investment agreement. And, you know, I noted with interest that Credit Suisse somehow ended up 4.7 billion sideways on this most recent family office issue. And I don't think their risk people must have thought they had a $4.7 billion downside there. So this question of how leverage, either explicit or implicit, cascading, however it works, you know, leads to that kind of volatility, that's something I'm probably more interested in than the valuations themselves. It's how they're being leveraged. Again, either actually or implicitly.
Got it. So maybe just to return to the inflation picture and the outlook for a minute, there's a question. Would you foresee, or do you hear from any business contacts, some likelihood of a return to the cost of living adjustment like COLAs that affected the inflation picture in the 1970s and 1980s? Or are there other structural things that could be returning into the business domain?
You know, obviously you've got a lot less union presence today than you did then. So the sort of formally negotiated COLAs feel like they require someone to negotiate with. You know, I'll note most businesses already have an implicit COLA, which is the annual merit increase pool. Most every business that I know of, it's somewhere between 2 and 3%. In my old firm, after 2009, I remember taking it from 3% to 2.9, just as a, you know, it had been a tough year for everybody, and wouldn't that be a better first digit? And people thought I was, you know, a ruthless animal. And so They're pretty stable. I mean, these 2 to 3% merit pools are pretty stable. I've not heard of anybody who's saying, "Oh yeah, my number's now 4." That would be the kind of thing I would pay attention to. I think people from a comp standpoint are very much in the mood of thinking, last year was a 1 year where maybe they didn't give comp increases. This year's a 1 year where maybe they'll make up for last year's lack of a comp increase. But I've heard anybody saying, some people will say entry level is moving up and it's no longer $11, it's 13 or even 15. But I just have not heard people say across the board, I'm doing 4%, not 3% or 2%. I just haven't heard it.
Got it. And maybe as a follow-up then, there's a question here, and this ties back to some comments you made on having experts available remotely in good fashion. How does that tie into the gig economy and the value added of labor? So will we see an expansion of the gig economy if we're making individuals then into folks that can work in small increments, or will people seek out different types of employment?
I think it's going to be very interesting how this sort of remote employment thing works. Because on the positive side, you can be anywhere today. I can be in 3 different places today, as I already have, and that's good. On the downside, the question of where do people learn and create their value from becomes relevant. And if you're talking about, upper end gig economy, then you do have to answer the question of where the skill replenishment comes from for the individual. And in my pricing expert case, I think I get it because they're always talking to people on the leading edge, and so they're constantly replenishing their skill. On the other hand, if it's sort of more of a one-way thing, I think it's entirely conceivable to become obsolete. It's entirely conceivable to have a remote job outsourced to India. And so maybe that's, what the gig economy turns like. It's a bunch of individuals in India, doing the gigs. We'll just have to see. But I think you are going to have a new competitive frame here. I think you're going to have companies out there who've decided culture matters and everyone's going to be on the building 24/7. And you got companies decide that lifestyle matters and I'll attract better talent remotely. And those companies are going to compete with one another, and we'll see who wins. And there'll be other companies that invest in a lot of real estate and other companies that have no real estate. And those companies are going to compete against each other, and we'll see who wins. Then there are individuals out there who are going to insist on coming in the office and mentoring and or being mentored, and people are going to insist on being home and avoiding their commute and working harder. And we're going to see who gets promoted out of that. I think it's competition's a good thing, and we're going to see that in spades here.
Maybe as a final question. Here, there's been a few items that have come in thinking about the Fed's broader mission, the longer term goals, and the ability to achieve the dual mandate employment and stable inflation, but in the context of a broader set of labor market goals, including inequality, other disparities, discouraged workers. Would you agree that the mission is broadening? And do you think monetary policy can be effective in solving all these problems if it's only one tool in the toolbox?
I think I would err on the narrow mission, humble mindset approach to this. I think there are many central banks, as you know, that only have prices as their mandate. We've got stable prices and maximum employment. That feels hard enough to do. So, that's my focus. That doesn't mean that maximum employment isn't an inclusive goal, and that doesn't mean that stable prices aren't in and around a target that we've described. But I just keep trying to tie that to the mandate we've gotten from our legislative authorizers. And to the extent something fits that mandate, I'm happy to work and think about it. But I just stay focused on that.
Well, President Barkin, thank you for both a fascinating discussion and for spending time with the GIC community. We hope you'll be able to join us for a GIC program again soon. Thank you very much.
Hopefully in person. Thank you guys for making the time today.
In person would be great. As a reminder before we close, a replay of today's executive briefing will be on the GIC website later today. We are excited to announce that our next executive briefing will be on Thursday, April 15th, and we'll explore the promise and perils of business startups with a focus on entrepreneurship, how entrepreneurs survive in normal economic conditions and during the era of COVID-19. This event is held in partnership with Yeshiva University. To find the video replays, please visit our website at interdependence.org. As we conclude, we encourage you to take a 60-second survey and give your feedback. It's important to us, and we appreciate you letting us know how we can improve our programming. Thank you for your attention, and have a good day.